Please join me in welcoming Professor Stephen Dean, the Faculty Director of NYU's Graduate Tax Program. Professor Dean.
Thank you very much. Thank you, Larry. So my name is Stephen Dean, not in the program, but that is my name. And I am the Faculty Director of the Graduate Tax Program here at NYU Law. On behalf of the faculty administration, I'd like to say how delighted we are to have you all here today. I joined NYU in January after a career in tax that I'm proud to say started at KPMG in 1995. Since then, I've had the privilege to get to know many of you when I worked at Cravath and Debevoise, and as a member of the executive committee of the New York State Bar Association's tax section. This is the 19th annual KPMG NYU event, and for each of those 19 years, Larry Pollack has been the program's heart. We are immensely grateful to Larry for all his work over the years. Thank you, Larry. He may not be ready to think about number 20, but I'm already excited about it, and I know I'm not alone in that. And thanks also to Maribel Wiskovich for her dedication and hard work. This event embodies all that is the best of NYU Law's graduate tax program. Like the symposium, the graduate tax program brings together people from all over the world, including policymakers, academics, and leading practitioners to both sides of the podium. As you all know, the graduate tax program has a long and rich history of training the best and brightest tax minds from around the globe. One of our many alums here today, we are fortunate to have John Samuels, LLM class of 1975, now the Senior Managing Director and Chairman of Global Tax at Blackstone, giving the keynote address. I hope to see many of you also on Tuesday, April 30th at the reception the Alumni Relations team is hosting at D'Agostino Hall, just across West 3rd Street. And it's great to see so many of our current students here today as well. I encourage each of you to seek them out and welcome them to the tax law community. The graduate tax program was created in 1945, almost 75 years ago. That, of course, was in an era when top rates surpassed 90%, and when the income tax transitioned from being a tax on a relatively small group of wealthy individuals to a tax that most Americans pay. Today, the rates are much lower, but the reach of the income tax, combined with the uncertainty and complexity of the global tax roller coaster you've been learning about today, show that the educational mission of the graduate tax program remains as important as ever. And I encourage any of you who are interested in following in the footsteps of our many distinguished alumni to reach out to me or to pick up one of the brochures that are outside on the table. Applications for fall 2019 will be accepted through June 3rd. So now, with no more ado, following up on an incredible morning, Larry has a great afternoon's worth of lively panels, including what promises to be a fantastic debate about the future of the international tax regime. Thank you very much.
Well, now is our provocative debate session that you've all been waiting for, where certain policy aspects of international tax reform will be vigorously debated. You're in for a real treat, as our debaters are all pumped up and they're full of views. This is going to be a true debate rather than a panel discussion. Those of you with handheld polling devices will also have an opportunity to respond to various polling questions during the course of the debate. The debate will be moderated by Diana Wollman, and the debate team includes Professor Daniel Shaviro, Kimberly Blanchard, Michael Plowsian, and Professor Itai Grinberg. Our moderator, Diana Wollman, is a partner with Cleary Gottlieb. Diana recently served as the Internal Revenue Service's first Director of International Strategy for the agency's Large Business and International Division, where she was responsible for developing and managing its international strategic program. Diana is a past chair of the tax section of the New York State Bar Association. From your left, Professor Daniel Shaviro is the Wayne Perry Professor of Taxation at NYU Law School and formerly served with the Joint Congressional Committee on Taxation. Professor Shaviro teaches tax policy-related subjects at NYU Law School and is a prolific author on topics involving tax policy, budget policy, and entitlements issues. Kim Blanchard is a tax partner with Weil Gotshal and Manges. Kim speaks frequently and writes extensively on many aspects of U.S. international tax. Kim is also a former chair of the tax section of the New York State Bar Association and a former president of the International Tax Institute. Kim earned her JD degree from NYU Law School. Michael Plowsian is a principal in KPMG's Washington National Tax Office. Prior to joining KPMG, Michael was a senior advisor on base erosion and profit shifting at the OECD. In that role, Michael helped lead the OECD's work on BEPS and worked with policymakers from OECD and G20 countries to develop the action plan on BEPS. And finally, Professor Itai Grinberg is a professor of law at Georgetown. Prior to joining Georgetown's faculty, Professor Grinberg served in the Office of International Tax Counsel at the U.S. Department of the Treasury, where he negotiated treaties with foreign sovereigns, had responsibility for a wide-ranging group of cross-border regulations, and was involved in international tax legislative efforts. Diana, over to you and the debate team. Thank you.
Thank you. Okay. So you all have clickers, and we are going to take a vote, and I will walk you through the clickers. Okay, so we are debating the following proposition. The Tax Cut and Jobs Act's international provisions are better than prior law. Okay, not that they're good, not that they're bad, but they're better than prior law. And in support, we have Dan and Kim, and in opposition, we have Itai and Mike. And so you'll note that we have a practitioner and a professor. Now, these debaters have been assigned their positions. They do not necessarily believe them, and the things that they say, they do not necessarily believe or think, okay? There's a chart of how things changed, which is pretty high level, but there it is. And then there's a list of things that make a tax law better or worse. And I'm not sure if that's the criteria that they're going to talk about, but we will see. And here is how we go about it. The first thing we're going to do before we do anything in terms of debate is we're going to take a vote. And we're going to take 3 votes. And the first vote and the second vote are the same. And the third vote is, did you change your vote between the first vote and the second vote? So the first vote is, are the international rules better than prior law? And now you should vote. And they're going to open up the voting now. And the question, if it's better, vote 1A. And if it's not better, vote 2B. And we will wait for all of you to vote.
The
18 seconds. Okay, we got 116 responses. Okay. Well, we know where we stand. Okay. So, Dan?
Well, thanks. So one of my favorite all-time desert island books is Alice in Wonderland and Alice Through the Looking Glass, and there's a scene there that to me epitomizes something about this debate. Alice hears the poem of Walrus and the Carpenter, who very meanly and nastily trick some oysters out of their oyster bed, supposedly to talk about things, but in fact to get eaten. After hearing the debate, here's a quote from Alice Through the Looking Glass. "I like the walrus best," said Alice, "because you see, he was a little sorry for the poor oysters." "He ate more than the carpenter, though," said Tweedledee. You see, he held his handkerchief in front so the carpenter couldn't count how many he took, contrariwise." "That was mean," Alice said indignantly. "Then I like the carpenter best if he didn't eat so many as the walrus." "But he ate as many as he could get," said Tweedledum. This was a puzzler. After a pause, Alice began, "Well, they were both very unpleasant characters." And that's where she ended her. So I think Alice has greater wisdom than the 4 of us, quite clearly, because we're sort of being asked to pick between arsenic and strychnine, you might say. Nonetheless, for the duration of this debate, I firmly believe my side. And I would like to point out why I think you could at a minimum, very reasonably argue that the TGCA International is better than prior law. So the first big thing is no more deferral. Deferral was a way of reducing the tax burden compared to a pure worldwide system, but it was a horrible way of doing it. It never made sense as a way of having the tax rate on foreign source income be lower than the tax rate, effectively speaking, on domestic source income. It led to taxpayers jumping through hoops to avoid taxable repatriations. It led to the crazy and then self-fulfilling PRE accounting rule. People would say they never bring the money home. It led to endless lobbying for dividend holidays. It created uncertainty. It made repatriation decisions depend upon what the tax director thought was going to be future versus current dividend repatriation tax rates. Horrible rule. So even if you want to have foreign source income tax less than domestic source, no reason to use that. So getting rid of that is a great thing. Second point, GILTI, for all its flaws, has some virtues too. It makes it harder for highly profitable US companies to pay a global 0%. At the same time, compared to some minimum tax proposals that have been thrown around, it only has an 80% foreign tax credit rule. And to my mind, that's a good feature because it preserves some incentive to want to save foreign taxes, not just pay foreign instead of US tax. So GILTI has some virtues. Third, the BEAT. For all its flaws, it does address transfer pricing. I think of the BEAT as kind of a weird dual rate excise tax, where it's a 0% tax on the counterparty payments that it covers, that then jumps to a 21% tax once you're off the the minimum tax features cause you to be on the BEAT. Anyway, it's sort of rough justice. It's not an ideal scheme, but having some sort of an excise tax on counterparty payments, given the unfixability of transfer pricing, is not completely ridiculous. At least the law now has more that can work on than just the transfer pricing regs. Fourth, and I'm going to let Kim talk about this in substance, but I'll just mention, is changes to 163J so that it affects inbound as well as outbound. So that's potentially a big improvement and an important one. I'm going to leave it to Kim to talk about that. Finally, there's room for improvement in this act. I don't know if we have the sort of politics or legislative process anymore what will happen. But these provisions, at least GILTI and the BEAT, are sort of innovative approaches. They can be tweaked and improved, and that possibility is there now that they exist. To give an example, the BEAT has some really crazy features, like there's just no reason whatsoever for the 3% rule for base erosion tax benefits versus total deductions. That just creates crazy cliff effects and has silly tax planning effects. What about excluding cost of goods sold? What other stuff is included? That doesn't make sense either. But in principle, you could make the BEAT broader and yet keep the rigor overall the same by cutting the rate. So there are real opportunities to improve these rules. Final point I'll say, you notice I haven't mentioned FDII. I haven't tried to defend that. It would be fair to say that I'm not a huge FDII fan, but it may not last long, and I don't think it's important enough to change the bottom line. So if you're already thinking by more than a peppercorn, better. I don't think that FDII alone is going to make the difference. So that's why I would say that 2017 Act arguably improved international tax law in the US.
Very good. And within the 5 minutes, Kim, you have 5.
Okay. So in a way, I'm glad that I only have to speak in favor of the new Tax Act, which is difficult but doable. If Diana had asked me to speak in favor of the EU's state aid decisions, I would have said no. Every girl has to draw a line somewhere. But actually, that kind of brings me to the first point I want to make. I mean, one of the great things about this new legislation is it really does ensure that our worldwide income of our CFCs is all subject to tax or exempt under 245 Cap A. And that means a couple of things. I mean, first of all, it means that there really is no more possibility of homeless income, which was really a big part of all the BAPS activities that we've seen. And in fact, if you look, for example, in the comment letters that private industry wrote on the IRS's foreign tax credit regulations, you'll see that these BAPS concerns and other things that led up to the present day did, in fact, cause multinationals, a lot of multinationals, to bring their intangible assets and IP onshore. In fact, that's why we were writing, because they were complaining about the application of 367D to those onshoring. But as a practitioner, I can tell you these rules are starting to have real effect, and an effect that was intended, in my view, by the legislation. Hopefully, as we see more and more of this, this will take some of the pressure off the stuff that continues to go on at the OECD, which you heard about earlier this morning. The second thing I kind of like about this is that it is in a way, a simple framework. I agree with Dan, and I'm sure my opponents, in saying that it could be better, it needs to be fixed at the margins. But big picture, we've got a simple framework that taxes pretty much everything, and then basically says, okay, here are your foreign tax credits, no more pooling, no carryover of guilty foreign tax credits. That sounds bad, it even sounds unfair, but I think what this legislation is really telling us is, stop relying on Uncle Sam to fix all your foreign problems. Go fix your foreign problems yourself. Take rational steps to keep your foreign taxes to a minimum. We're only taxing you at 21%, so, get on with it. And so I think it's supposed to be simple, and it's supposed to be a little bit of rough justice. Tracked credits, it's a strong incentive to make sure that you're not moving things offshore that don't belong offshore. If they don't belong offshore, bring them onshore. And, as much as FDII could be criticized, the goal of FDII, and we'll see whether it takes, is to try to neutralize the location decision between where you put activities. Either you do them directly in the United States, targeting foreign markets, or you do them through a CFC. And again, I think the idea is you got to have a good reason to be offshore. It was mentioned this morning that so-called 1050 companies, what we used to call 1050 companies, probably get the best deal of all under this legislation, at least if they're owned by domestic corporations as opposed to individuals, which we won't have time to talk about. And maybe the reason that 1050 companies got the best deal is because in that kind of situation, it's clear that there's a strong non-tax business purpose to be offshore. Otherwise, you wouldn't be in that situation where you are not in control of foreign operations. So I think that the overall design of the legislation is consistent with this main theme of bringing things back onshore and in effect penalizing things that are offshore unless they really need to be there. Do I have one more minute?
You have one more minute.
I wanted to talk about the inbound aspect in 163J. In my mind, this sort of adoption of one of the BEPS platforms is a really good thing. It's across the board. It applies both domestically and foreign. It applies to unrelated and related parties, unlike old 163J, which really didn't do much of anything. It really bites, and it will, I think, over time, really change the way that tax planning is done in this country and reduce the appetite for leverage. So I'm a big fan of it. I think in combination with the BEAT, for all its flaws, and GILTI, and 367D, I think a combination of these, what you're going to see, and this was designed, in my view, was fewer tax transfer pricing controversies, fewer debt equity controversies, more just rules and modeling. And so that's my take on the new legislation.
Wonderful, and within the time. Thank you very much for your eloquent and powerful words.
Right.
5 minutes.
So we're going to speak 5 minutes each, but not synchronously. So Williams Wordsworth once said that success is defining the terms by which you will be judged. The drafters of the 2017 Act proved him wrong. We all know that tax policy is hard, so Michael and I want to grade the drafters on a curve. And to make it as easy as possible, Michael and I propose judging them on the curve they set themselves, their own goals. And on each of the dimensions that they claimed were their goals with respect to the international provisions, they failed on every count.
Actually, Itai, you're being too generous. Everybody knows that the international provisions of old law were atrocious, right? They were complex, they were massively inefficient, they were easily manipulable, but also had tons of traps for the unwary. And not only did the TCJA fail to make it better on the dimensions that they targeted, they unbelievably made it worse.
Yeah, but you know us modern day academics, we're always working on grade inflation. What used to be a B is now an A minus. What used to be a C is now a B. And what's a C minus now? Well,
right,
oh,
okay.
lordy.
Okay. Now that you're done defending academics, let's talk about what were the goals of the TCJA, taken
Those are
directly
like an act.
from the legislative history. And the overarching goal of the act was to make the U.S. tax system more competitive. The idea being that you should get rid of the impediments, the tax impediments, to having U.S. parented multinationals. Again, the idea being that that would help improve the employment prospects for Americans in future generations. Makes good sense. And the drafters of the TCJA said that actually has two different pieces, right? So you've got competition between U.S. multinationals and foreign multinationals when they compete in foreign markets. And the second piece is the competition between U.S. parented multinationals and foreign multinationals when they compete here in the U.S. market.
Exactly, Michael. Old law made foreign ownership of almost any business more attractive than U.S. ownership from a tax perspective. That created incentives for foreign takeovers, for inversions, for U.S. companies to produce abroad for the U.S. market, and for income shifting. Given home country bias for high-quality jobs, the drafters thought that old law was harming competitiveness, and that was creating negative consequences for U.S. employment. So what they do about that? Well, in their press release, they said they were adopting a territorial system, more like those imposed by the jurisdictions of most major foreign MNCs. But we all know they also created a beautiful new tax that applies to U.S. MNCs and U.S. MNCs only, and they gave it a beautiful name, the GILTI. So let's talk about our so-called territorial system. Based on conversations with the accounting firms, somehow, despite Section 245 Cap A's dividend exemption, our territorial system taxes 80% plus of CFC income currently. So if the goal was to compete with dividend exemption systems, well, that sure seems like a clear fail. Other major developed economies on Earth have true dividend exemption systems, limited CFC rules, and no expense allocation. Instead, they generally have like a 5% haircut on expenses, which translates to something like a 1% minimum tax. So 1% minimum tax or 10.5% before expense allocation, which is more competitive.
That brings us to U.S. multinationals and foreign multinationals competing in the U.S. market, right? This was and is a huge issue. The legislative history goes into a lot of detail about how foreign-parented multinationals are much more easily able to erode the U.S. tax base than U.S. multinationals. And the JCT actually recently came out with a presentation that said that the U.S. base erosion percentage for foreign firms was 15.85% in 2014, whereas for U.S.-based multinationals, the U.S. base erosion percentage was 7.75%. So more than double the base erosion by foreign-parented multinationals. And the TCJA was going to fix this. It was going to level the playing field. At the same time, right, over the past couple of years, and we've heard about this on other panels, you've had a number of unilateral measures by other countries to get more source country taxation. That's leading to instability. It's leading to a conversation at the OECD about fundamental changes to the global tax system. And so what we should have seen as part of U.S. tax reform would be to have the inbound provisions give the U.S. leverage in those discussions.
Huh, that sounds familiar. Mean we should have chosen a pragmatic and administrable rule that hit foreign MNCs harder than U.S. MNCs, but could be modulated by Treasury and through tax treaties? I think I remember someone testifying about that to Congress.
Yeah, who could that have been? But instead, we got the beat, right? And the beat generally hits U.S. multinationals harder than foreign parented multinationals because of the loss of foreign tax credits. And again, another panel went through that in more detail. But just to give you, again, a sense of the size, right? JCT said for 2014, for US parented multinationals, you've got $48.9 billion in FTCs in 2014 versus $7.7 billion for foreign parented multinationals. In other words, for foreign parented multinationals, they generally can manage the BEAT liability because it's generally for them a partial deduction or denial of deductions. Whereas for US multinationals, if they're in the BEAT, it is a total disaster because of the loss of deductions and credits. We see lots of examples where US parented multinationals, if they don't change their business to get under the 3% threshold, they have an ETR over 100%.
Right, so instead of a leverage provision, what we have is no leverage at all, and we've successfully succeeded at simultaneously penalizing domestics and convincing every foreign jurisdiction that we've engaged in a deeply unprincipled move that is supposed to whack only their companies. What's not to love? It's just the worst of all possible moves, both as a matter of tax policy and as a matter of international tax diplomatic strategy. Okay, so it's clear, a C- in modern law school terms.
Which is really an F-. But maybe there were secondary goals, right? Maybe they did okay there, and we can give them a passing grade.
Let's see, what were the secondary goals? Reducing incentives to shift intangible income offshore and encouraging US taxpayers to locate intangibles and intangible income in the United States.
But you get FDII benefits for moving your IP offshore. I mean, it even says that in the preamble to the proposed regs, which is insane. On top of that, right, if you want to bring IP back into the US with or without a basis step up, that gives rise to a BEAT payment and you get whacked with the BEAT. So you've got massive incentives not to bring IP into the US. Not only that, right, if you're a services company and you have your principal in the US and it pays the foreign affiliates for the work that they do, massive disaster under the BEAT. It incentivizes you to shift your principal company offshore, shift the residual profits offshore, and just pay the US for the little bit of work it does here.
So another C- there. How about ending the lockout effect? I can't say I really understood why we cared that much about this one, but the legislative history does identify it as a goal.
Yeah, and Kim and Dan have talked a little bit about this, and admittedly, there was some improvement there. But I think it's important to note, as noted on another panel, that they didn't actually end the lockout effect, right? They left in place the PTI regime and the foreign currency impacts, and as we've discussed, all of it is PTI. And so APB 23 actually still does matter to a lot of taxpayers.
Okay, so last one, reducing complexity was a stated goal of the TCJA. Even on a modern law school curve, that's special. D- in a world where there are no Fs? Not that I mind. The name I use for the act, the Tax Jobs and Cuts Act, highlights how great it's been for employment prospects for my students. And on that dimension, I just have to concede to Dan and Kim. The act is, in fact, better than old law.
Okay, thank you very much. That was not expected. They clearly prepared. Okay, you guys get 5 minutes to rebut.
Well, I think the choice before us is clear. Lewis Carroll or Wordsworth. I continue to stand with Lewis Carroll, and I also think that they've cleverly changed the terms of the debate. They want, along with Wordsworth, they want the TGCA to be judged by what the proponents said were their goals. Well, of course, that came out pretty miserably, but the question is better than prior law. So prior law, that's a pretty low bar. That's, Itai, if we're going to, if you're forced to grade in a curve, once you've graded prior law, you might have given away your C-. You might not have it left. A lot of what they said, I would find it quite difficult, unless I were offered a large fee, to disagree with. But one, we're not comparing it to their claimed intentions. We're comparing it to prior law, which is a very low bar. And two, what was there before was very bad. I wrote a two-part article in Tax Notes about this legislation. I called it the new non-territorial U.S. international tax system. the fact that it was actually in some ways tougher than prior law, though it actually does, depends how you count it, it does actually lose revenue if you kind of get rid of the transition effect, which kind of implies that companies do a little better under it. Obviously, that includes the 21% rate. But the fact that it's not a pure territorial system is actually a virtue. We could debate whether it's too tough or too easy on U.S. multinationals. But none of the territorial countries have real territorial systems. So it's actually a virtue that it did this. And again, if you're taking I think Kim and I are pretty much forced to say, well, you can tweak it and make it better. You have these structures, and they can perhaps be improved. What prior law really had was deferral doing a lot of the work. And I agree with Itai that the lockout is relatively trivial, but it's just a very bad way to run a system when you have deferred future taxes, and then you get lobbying for holidays, and you get people playing games to decide when they're. It was such a bad system that I think this does put a structure in place that could be made better, even if it's not quite there yet.
Yeah, I guess I'm the straight man on this panel today, which is a little strange for me, but let me try to engage. I think that even on the terms in which they, disingenuously opposed this debate, I think we win, and I think that the reason we win is because this legislation really did make U.S. taxpayers more competitive relative to the old system. I think without question it did, and it did that in a couple of ways. First, the most important one is we lowered the rate a lot for corporations, and so that took a lot of the pressure off the table in terms of inversions or going to other countries. We also did at least limited territoriality with the dividend participation exemption. We haven't mentioned on this panel, but we have write-offs for investments in property, which is not limited to the international, of course, which is why we didn't mention it, but it's still a very important part. In enacting the BEAT, which is easy to beat up on, but in enacting the BEAT and 163J, we took a lot of the advantage, the relative advantage that foreign parented taxpayers had over U.S. parented taxpayers away. We didn't completely eliminate it. It's a bias that's built into our system. And we could have a whole debate on exactly how that works out. But we certainly, the Act certainly narrowed the difference in favor of U.S. multinationals. And the last thing I'll say, if I have just 1 second, is
You have a minute.
okay. I'll speak more slowly. Complexity, yes, it's complex. And the reason it's complex, in my mind, the main reason is trying to layer something like GILTI on top of Subpart F, with its E&P and PTI, and we talked about some of that this morning in the panels, and we'll be talking about it for a long time because it's a big mess. My hope is that in the not very distant future, as the U.S. leads the way to global minimum tax and something that kind of makes sense, who knows what's going to come out of Pillar 2 that we spoke about this morning. But in the not too distant future, we will come up with something that will enable the United States to fold Subpart F into GILTI and get rid of Subpart F. And we will have a simple, universal system that will be actually quite simple.
Okay, thank you very much. 5 minutes for rebuttal.
Great. So I love the fact that we've been called out on having disingenuously changed the terms of the debate, and then immediately afterwards they claim the rate. Okay, so it's true that a separate purpose of the Tax Jobs and Cuts Act was to reduce our high corporate tax rate, but that change was a general purpose one. Okay, not an international provision. Lowering the rate from 35% to 21% provides a path to forgive many of the sins of the Tax Jobs and Cuts Act, but it does not change the fact that the international provisions are a terrible sin, okay? And to be clear, that's called like a non-topical argument in debate, if anyone remembers high school debate, right? And the difference here is they had a chance to like weigh in on what the resolution was, so hold it against them, okay? Now, in that case, I'm gonna pass it over to you.
Thanks.
You did it first.
Anywho, so I want to talk a little bit about a couple of arguments that Dan and Kim have made around ending deferral and tax planning and narrowing the difference between U.S. parented and foreign parented multinationals. I think clearly, as we've talked about, right, it didn't end deferral. There are still tax impacts to the U.S. shareholder on repatriation of earnings in the vast majority of cases. So I think that's just false. I think also, as we sort of went through in more detail in one of the earlier panels, this idea that we've got this worldwide system that then gets rid of tax planning also is just clearly false. You've got lots of different buckets of foreign income. You've got foreign branch income that's subject to full tax and full creditability. You've got GILTI, which is subject to reduced tax and reduced foreign tax credits. And you've got exempt income, including high tax subpart F income, where you make an election. And your control over where in those buckets your income falls is actually pretty high. So there is a lot of foreign tax planning or foreign income planning to be done in the new system. So I think that premise is just false as well. And then this idea that we narrowed the difference between U.S.-based multinationals and foreign-based multinationals is just wrong across the board, right? It's wrong for the BEAT. The BEAT made that worse. It's wrong under GILTI. GILTI made U.S. multinationals less competitive, and it increases the incentives to have foreign-parented multinationals.
Right. So more things about the BEAT. I mean, the BEAT treats foreign taxes the way domestic law treats paying bribes. Like, this is the provision they're defending, okay? Let's be clear. And that's the main impact of the provision. That's kind of David Rosenblum's point. The only thing, well, we can get off on that. The other thing is, on the international point that Kim makes, we recognize that there's a discussion about agreeing some global minimum tax regime at the OECD right now. And for the sake of, United States competitiveness and national interest, we hope it succeeds. But in reality, the most likely consequence of enacting this significant minimum tax is that it will apply only to US MNCs, that the OECD process will more or less fail, and that business people and tax professionals will conclude that the best way to protect a business asset from attack by both the US and foreign tax authorities is, in fact, to take it out of the US tax net. We will just be back to the inversion game all over again, except we may have some OECD rules that say that if you don't have the right kind of a minimum tax, you should get whacked, and no one will agree who has the right kind of a minimum tax. So hooray. Thank you, US tax reform. Beyond that, I guess what I would say is that, in this debate, Dan says that it's an act of improvement of old law because deferral included wasteful planning to avoid tax repatriations and foreign tax credit, that reduce the incentive to minimize foreign taxes. But the wasteful planning of affirmative sub F, FDII, and benefits, BEAT avoidance, that's just worse than what was before. So, I guess in conclusion, the thought is, well, the corporate income tax is still dying, folks. Tax reform should have built an old age home. Instead, what we got is an attempt to save the corporate income tax forever, and the problem with that was that it was like that snake oil elixir that gets sold, right? Those elixirs infamously often had highly detrimental and unforeseeable side effects that were worse than the disease. Like that, we think the international provisions are worse than the disease they were meant to cure.
Thank you very much. Okay, now I, who have been listening intently, get to ask each debater a question. They have no idea what I'm going to ask, and I almost have no idea what I'm going to ask. Here we go.
You know what you're going to ask.
I hope I know. Dan, first question is for you. Kim spoke eloquently about her experience as a practitioner, seeing actual changes in behavior, and saying that the proof is in the pudding, and she's been eating the pudding, and she's seen it. So if you're right, and the TCJA is really a halfway house towards nirvana, how can companies change their behavior if the law is going to keep changing?
Well, they sort of know that's the world we live in, unfortunately. I want to bring out something Kim said a year or two ago, which I thought was very insightful and which happens to support our side of the debate. She pointed out, she actually complained, understandably, that instead of like having, it's now kind of based on these numerical counts about the 3% rule and stuff like that, they're just running scenarios. The accounting firms are running scenarios instead of the lawyers doing a lot of legal analysis. And I realize that's bad for, it's bad for our students and
Great for our students.
but it's, well, no, because they're not running the arithmetical scenarios. It's kind of better to be running pointless arithmetical scenarios than even however unedifying that might be, than to have lawyers doing a whole bunch of pointless tax planning to access funds without formally repatriating them, and to play transfer pricing games that, although it's all still there, it'll be a little less relevant. So I think the fact that it's kind of debased tax planning, if you will, and turned it into accounting running scenarios about if your profits are high, if your sales are low, that's kind of maybe doing less harm than running the clock about lawyers coming up with the complex schemes that we saw under prior law.
That's not actually what I had in mind when I said it.
I know. That's the beauty of it. That makes it support us
Go ahead,
even more.
you have time, you can,
No, I was just a joke.
okay. Well, Kim, why is it that we should not judge the success of the act by what the goals were?
Well, first of all, I'm not sure any of us really knows what the goals were. When the opposition started out saying the goal was to make U.S. multinationals more competitive, the dean, the guru, the czar of that issue is going to be speaking right after us. I don't know if John's in the room, but I'm not going to go there. I didn't necessarily think that was the goal of the act. One of the goals of the act clearly was to bring stuff back on shore. I was going to say jobs because, you know, it's always an interesting issue whether you're bringing jobs back on shore or money back on shore or tax revenues back on shore, what exactly you're bringing on shore. But that was clearly one of the goals, and I think may have succeeded. But I don't know. I think a big part of this was just to lower the rates, adopt something that looked a little bit more like the rest of the world's, which is how we got to this strange hybrid provision, which all of us have stayed away from for good reason, this strange EU import into our system. But I think the goal was to try to be more of a player on the world stage, and I think we're getting there. I mean, you know, Chip Harter's been running around the world telling everybody, you know, we're leading the way, and everybody's following. So let's see how that goes.
Let me just quickly add a goal. One of the goals of the international provisions was not to lose as much revenue because they wanted to throw it all to the pass-throughs. As I put in my piece, the multinationals were liked, but the pass-throughs were well-liked. So they had a goal of not like sort of corruptly giving away the store here, and that meant that they were, so one of their goals was not to be as lax on international. Now that doesn't prove it was right or wrong, but at least a kind of indefensible and disgusting type of motivation that was behind some other parts of the act was sort of off the table here because they wanted to make the multis pay a little bit. Again, good or bad, at least means they weren't doing what they were doing elsewhere in the act.
Okay, thank you. So, Itai, one of the things that you accuse them of changing the debate, they accuse you of changing the debate. It's pretty hard to, you know, resolution to debate, I agree. And let's all, you know, admit it, you guys had the easier side.
The numbers are right there.
Only because they didn't change the resolution on the pre-call. They lost
Okay.
on
We're
the
hoping for
pre-call.
0 to 100. So.
One of the things that I want to ask you about is that you proved that the new rules are bad, but did you prove that they are worse?
So I think we did prove that they are worse.
But you didn't talk about current law, I mean prior law.
So we talked about all the features of prior law that one would describe as atrocious. And then we made the claim that, in fact, on each of these dimensions, there's no improvement. But in addition, you get all of the oddity of BEAT. You get the non-competitive nature of a minimum tax regime. And remember, we, because they did not change the resolution in the pre-call, get the benefit of not having to worry about the rate cut, right? We could have changed the word to corporate. Then we'd been in real trouble. But we had the international rules. That was good. And so as a result, you don't have any, so when this is all over, when things settle down, we're going to find out that US-based multinationals still want to invert. There's still incentives to shift jobs abroad. There's still incentives to shift real investment abroad. And on top of that, right, you have all of the oddities of BEAT plus the non-competitiveness of being in a minimum tax regime when no one else in the world is. And I suggest to you that regardless of the OECD process, no one else in the world eventually will be either. And again, you remember, if you're in the press, anything we say, we may or may not believe on this panel, because I believe I have an article that says something that's like quite different than that. So let's just be clear.
I'm going to take out my phone and start.
Yeah, right. Read it back
Live
to me.
tweeting.
Yeah, right.
Okay, so, Mike, so you guys acknowledge that prior law was bad, and why is it not the case that anything that is a change is progress, and that and why is Dan not right that
Donald Trump was
what we've done is we've put in structure in place that is better in the sense that we are changing behavior and we are going to be able to fix the rules to make them the best possible rules.
Yeah, so I think on the first proposition that any change is better than prior law, that's just flatly not correct. We've been through.
The moderator also doesn't believe what the moderator.
Been through the issue of deferral. We've been through the issue of complexity. We've been through the issue of the preference for foreign multinationals versus U.S. multinationals under old law, and each of those got worse under the TCJA. I think the other piece, right, in terms of what Dan has said, there is maybe some truth to what Dan has said about the TCJA provisions could be good if they were changed. That's not the proposition we were debating.
Give him a break.
Right? I don't know what a hypothetical TCJA looks like, and that's not what we're living with. We're living with GILTI and BEAT and FDII as they were written, and all the problems that come along with that. In terms of the last part of your question of changing behavior, clearly when you turn the world upside down in terms of tax planning, it changes taxpayers' behavior, and we are absolutely seeing changes in what taxpayers want to do. Now, is that better for the U.S. system? I would say probably not. I don't know. Maybe
trial and error. What happened with good old trial and error?
Now, I want to respond to something that Kim said about bringing IP onshore. Now, I obviously don't know what Kim's experience is. My experience is that the IP might be going onshore, but it's not going onshore to the U.S. And I think that makes a big difference. I think that the TCJA is not achieving its goals there. And then finally, I would say in terms of GILTI, right, and this idea that GILTI would have prevented BEPS, it got rid of stateless income. It clearly did not stop BEPS 2.0, right? Other countries don't care that the U.S. is taxing this income. They want their piece of the pie. And so I don't think it's helped the U.S. in that regard either.
Thank you. Okay. Well, I think we all learned a lot. But now I want to learn how they have done in terms of convincing you. So we are going to take our second audience vote. And this vote is exactly the same as the first vote. And there's going to be a third vote where you're going to vote whether or not you changed your vote from the first to the second. So based on what you heard here today, the question is, are the TCJA's international provisions better than prior law? And they're opening the voting now. There we go.
Oh.
Okay, can you put up the second
By
screen?
95 to 5. They're gonna lose. There are only 5% of the people went against it.
Okay. So,
That's victory.
okay. So the not better grew. That was not what we wanted to see. Okay. Okay, let's go to the third vote. I'm hoping that everyone changed their vote and it's just a coincidence that the numbers were so close. So the third vote is, did you change your vote? And if your vote changed, vote 1A, and if your vote did not change, vote 2B. And just, you know, humor me, vote 1A. You can lie too, just like this. In most debates, you don't know what position you're going to have until you arrive, and then they assign you the position. That would have been much fairer. Okay, here's the moment I've been waiting for.
Oh, well, lots of people lied.
22% of you changed your vote. Okay, that's success. You guys changed minds.
What was the quote? You define success based on what?
The terms, success is defining the terms by which you will be judged.
Oh, okay. Well,
No, success is the fact that 22% of the audience changed their vote because they were so persuaded by your advocacy. Okay.
And that 5 went towards them. So we did pretty well.
Okay, that is the end of our show. Thank you. You guys were fantastic. I have to tell you that they were really fantastic. I think it was a very, very, very hard debate. And you guys really did great. Thank you.